Good afternoon. Matt Liddycoat here with Nova Home Loans, Director of the Liddycoat team. Just wanted to take a quick minute to talk to you a little bit about VA financing, financing specifically of a VA purchase. I had a great conversation with a past customer of mine earlier this morning as I was getting my salad from Safeway and heading on into work. We talked a little bit about the concept of this individual buying a new home but really wanting to use his VA transaction again. He currently has a home that he's living in and has a VA loan on it, and he's under the impression that because of that scenario he would have to sell the house and pay off that VA loan before he could get an additional VA loan. That is a misconception. VA eligibility, the VA guarantee, is something that would be recalculated on a case-by-case basis. So there could be additional eligibility for this individual based upon the amount of money that they have originally borrowed under that current VA transaction. Now in this case, this individual is being very prudent and doesn't want to carry two mortgages, so we would go through the process of qualifying this person based upon the contingency that they would sell their home. And in that case, obviously, we would be paying off that VA loan and starting the new VA loan and doing some level of a simultaneous closing. So at that stage, Nova would be communicating with the VA in order to go ahead and let them know, hey, that old VA loan is paid off and here's the new one for this particular individual's eligibility. I think the key takeaway here is the concept that if you have a VA loan, do you have additional eligibility for another VA loan? And the answer to that is possibly yes. We would have to do the math, we'd have to do the calculations, but it certainly can take place. Something that people also don't quite understand on VA transactions is that they are 100% financing and there is no mortgage insurance associated with it. In exchange for that, the VA wants a funding fee on the transaction. The standard would be for regular military 2.15% of the amount of money borrowed. That's for a first-time use. If you're a subsequent use, it would be 3.3% of the amount borrowed. These are both for 100% financing situations. Effectively, though, that replaces the mortgage insurance. So you have just a principal, interest, taxes, and insurance payment on your house, as opposed to any additional mortgage insurance that would be on another type of a loan, FHA or a conventional mortgage, with less than 20% down payment scenarios. So it's a very advantageous situation. Well, a lot of people will say to me, well, Matt, doesn't that create an undue level of risk for VA? Aren't those loans that would be one that would potentially default? Well, my response is simply this. VA lending has excellent criteria when it comes to vetting the borrower and their ability to repay. The VA has always had a residual income calculation, has always required lenders to determine a square footage multiplied by a utility multiplier, if you will. So we're considering the concept of bills on the house, utility bills on the house, and then we're also considering taxes, Social Security taxes, things like that of the borrower when we calculate what's called a residual income calculation to determine is the cash flow of the borrower sufficient to not only carry the debt of the home, but also their other debts, their taxes, and utilities within the home as well. VA does a very good job of vetting the borrowers. These are very solid transactions. If you're a veteran, if you're in the military, if you have these options available to you, they're definitely something you should be taking a look at. And remember, if you're a disabled veteran, it is possible that you would have the funding fee waived because of that issue. If you'd like to talk a little bit further about this, please give me a call at any time. Our number is 520-579-1700. That's 520-579-1700. Thanks a lot. Have a great day.